Financial statements for non-financial managers. Topic 2, what the balance sheet can and cannot tell you about your company. Part 1. This topic aims to guide you in the proper management of your business and how to maintain complete and simple accounting records. We want to provide you with the fundamentals of accounting and help you understand the main financial statements so that you can later use them in your business after proper interpretation. In this Part 1, we will focus on providing the participant with the basics of accounting so that they can later work with financial statements and thus be able to use them in their business after interpretation. So, what does a business need? Accounting system, record keeping, cost system, sales system, wholesale retail, expense control, tax compliance, preparation of basic financial statements, financial statement analysis, budgeting and forecasting of sales, purchases, collections, expenses. Accounting. It is a discipline that teaches the rules and procedures for organizing, analyzing, and recording the transactions carried out by economic units, whether constituted by a single individual or in the form of civil or commercial companies, banks, industries, businesses, etc. Another definition, attempting to expand upon this explanation. It is a technique of summarizing, recording, and classifying all the transactions carried out by a business, whether in cash or in kind. The Accounting Principles Commission of the Mexican Institute of Public Accountants defines accounting as a technique used to systematically and structurally produce quantitative information, expressed in monetary units, about the transactions carried out by an economic entity and certain identifiable and quantifiable economic events that affect it, in order to facilitate decision-making by various stakeholders regarding said economic entity. The fundamental purposes of accounting are 1. To establish rigorous control over each of the business's resources and obligations. 2. To record clearly and accurately all transactions carried out by the company during the fiscal year. 3. To provide at any time a clear and truthful picture of the business's financial position. 4. To anticipate the company's future well in advance. 5. To serve as proof and a source of information for third parties regarding all legal acts in which accounting records may have probative value as established by law. Other purposes and concepts. Recording. This means that each and every transaction carried out daily will be recorded. If this weren't done, at the end of the period we would only have part of the information, which would not be informative at all. Classifying. This means that businesses have constant transactions. For example, selling, we classify it as sales. Buying, we classify it as purchases. Acquiring goods, we classify it as assets. Spending, we classify it as expenses. Acquiring debt, we classify it as liabilities. All of this is based on the source document, which is the original physical or digital receipt that proves and supports each financial or commercial transaction of a company. Different types of accounting. The main types of accounting are divided according to their objective and the intended audience of the reports. The most important are tax accounting. Tax accounting deals with determining tax obligations in compliance with the law. Financial accounting. Financial accounting is the process of identifying, valuing, and presenting quantitative information. Management accounting. Management accounting is an information processing system created to support management in planning and controlling operations and making better decisions. Auditing. The auditor has the responsibility to gather sufficient evidence to form an opinion with certainty. Management. Its purpose is to maintain control over all activities related to the company. Its use can bring you great benefits that will ultimately be reflected in the results. It's true that everyone has their own way of doing things. But what is undeniable is that planning, order, and control of activities are compatible with any style. Administrative process. The administrative process is divided into 4 fundamental stages: planning, organization, direction, and control. However, when specifically referring to 5 phases, staffing is included as a key intermediate step. Planning. what it is, defines the direction and goals of the company. Key actions: set clear objectives, establish strategies and action plans, analyze available resources and the future environment. Organization, what it is, designs a structure to distribute work and resources. Key actions: divide tasks by departments or roles, assign responsibilities and levels of authority, define reporting lines, hierarchies. Staffing, gathers human, material, and financial resources, is responsible for the recruitment, selection, and training of personnel, defines who will fill each job position. Direction, what it is, guides, leads, and motivates the team during execution. Key actions: make decisions and give clear instructions, motivate and lead staff, facilitate internal communication, control dynamic phase. What it is, measures and evaluates the results obtained against what was planned. Key actions: monitor the progress of activities, detect errors, deviations, or problems, apply corrective measures to improve the process. Managerial accounting. It is useful for decision-making, maintaining a clear and accurate record of all business transactions, controlling everything related to the business. Elements of accounting: entity, company, resources, classification of resources, obtaining resources, source of resources, finance. Accounting period. The financial information resulting from accounting is known as financial statements. These are prepared at least annually. Therefore, the life of every business is divided into 12 cycles, months. Financial statements must be prepared each month. Each activity cycle, accounting period, is closed. Basic principles of NIFA 2, economic substance, requires the capture of the economic essence. Economic entity, identifies and defines entity. Accounting accrual, matching of costs and expenses with revenues, valuation, and economic duality. Establish the basis for the accounting recognition of transactions. Going concern, assumes the continuity of the economic entity. Consistency, indicates that similar transactions of an entity must have the same accounting treatment and be maintained over time. Essential aspects of accounting. The account. An account is a systematic record of a specific type of transaction. A business must maintain many accounts, each of which describes a specific asset, liability, and equity item. Another definition of an account is the record where the variations produced by transactions in the different asset, liability, and equity categories are systematically tracked. Asset accounts. Asset accounts track the goods and rights owned by the company. Liability accounts. Liability accounts track the debts and obligations of the entity. Equity accounts. Equity accounts track both the profits and losses of the company. Main asset accounts. Cash. Cash refers to the money in hand, including banknotes, coins, checks received in bank, postal, or telegraphic money orders. This account increases when cash is received and decreases when payments are made. Banks. Banks refers to the value of deposits made by the business in banking institutions. Merchandise inventory. This refers to everything that is bought or sold. This account represents the assets owned by the business. Customers. These are individuals who owe the business for merchandise purchased on credit and for whom no special documentary guarantee is required. Notes receivable. These are credit instruments in favor of the business, such as bills of exchange, promissory notes, etc. Other debtors. These are individuals who owe the business for reasons other than the sale of merchandise. Land. These are the properties owned by the business owners. Buildings. The buildings account consists of the houses owned by the business owners. Furniture and equipment. Furniture and equipment includes the furniture, chairs, desks, etc. owned by the business. Delivery equipment. This account includes all transport vehicles, such as trucks, vans, etc., used for the delivery of goods. Machinery. This represents all the machines used by industries for their production. Security deposits. This consists of the contracts that secure the amounts held in escrow to guarantee goods or services that the business will receive. Installation expenses. These are all the expenses incurred to adapt the premises to the needs of the business, as well as to provide it with a certain level of comfort and presentation. Stationery and supplies. These are materials and supplies used by the company, such as pens, paper, envelopes, ink books, cards, erasers, receipt books, etc. Advertising and publicity. This refers to the means by which particular activity, service, or product that the business produces, or sells is made known to the public. The most well-known media outlets are newspapers, magazines, television, radio, etc. Insurance premiums. These are the payments made to insurance companies, which acquire the right to insure your business assets against fire, theft, accidents, etc. Prepaid rent. This is the amount of one or more monthly, semi-annual, or annual rent payments for the business premises that have been paid in advance, even though they are not yet due. These prepayments are made either because the lease agreement stipulates it, or because it is in the best interest of the business owner. Prepaid interest. This is the interest paid before the loan's due date. This applies to loans where the interest is deducted from the original amount received. Main liability accounts. Suppliers. They are the people or commercial houses to whom we owe or have purchased goods on credit, without giving them any documentary guarantee. Documents to pay. By these we understand the credit instruments in charge of the business, such as bills of exchange, promissory notes, etc. Various creditors. They are the people to whom we owe for a concept other than the purchase of merchandise. Mortgage creditors or mortgages payable. They are the obligations that are guaranteed by the deed of real estate, land, buildings, that are permanent and durable assets that cannot be consumed quickly. Interest collected in advance. These are the interests that are not yet due and that have been collected in advance. Rents collected in advance. They are the amount of one or several monthly, semi-annual, or annual rents, which are not yet due and have been collected in advance. Thank you for following along with this first part of Topic 2. We will soon provide you with Part 2 of Topic 2, which covers the fundamentals and analysis of the main financial statements. Follow us to access the complete syllabus and its components.